Hello, everyone, and welcome to the third episode in the Marine Money webinar series on the oil and tanker market outlook. This topic has drawn a lot of interest with over 270 people registering for the event, which is a good thing as it has broken our previous registration record. However, it has also given Ali bragging rights, which I'm kind of on the fence about. I'm your host, John Chair, and today we will be taken through this thrilling market environment by none other than the industry seer, Ali Sterling from Marsoft, and his reputable colleagues, Kevin Hazel and Aditya Trivedi. Now, before we get going, I want to apologize to anyone who had trouble signing up in the last 12 hours. It would seem that during this pandemic and subsequent lockdown that I've developed a magnet in my body that is hindering my ability to use technology. So, please alert me via the chat box if you have anything if you see or hear anything go awry. Now, that being said, I would like to inform the audience on some ground rules before we begin. You'll be on mute during this webinar to ensure quality control of the audio. But during this webinar, you have a control panel that will allow you to do a couple of actions. I'm going to show that on my screen now. And today, there are three primary actions that you will want to take. The first is to ask a question. We love questions as it makes the session more interactive. And you do that by simply entering a question in the text box at the bottom of the control panel where it says questions. I will receive them at the end of the webinar. I will ask the question on your behalf. The second major action is that during this webinar, we have some polls. This will require your participation. When the poll pops up on your screen, please click on the answer you think is most appropriate and submit it. We will leave the poll open for approximately 10 seconds, so go with your gut. It's always the best answer. And the third major action is the ability to collapse the menu that is taking up probably a third of your screen. So you see that little orange-red button that's kind of at the top with an arrow. You click on that and it should collapse the control panel. So now with all that boring technical part out of the way, I'm going to hand over the controls to Ali and let Ali take it away.
Thank you very much, John. Really appreciate the opportunity to talk about one of our favorite topics, what's going on in the tanker market, and look forward to a discussion around that. As John, you've set up a nice interactive session for us. So what we're going to talk about today is the outlook for primarily the VLCC market. We'll be using as an example, but it's really a bellwether for the market as a whole. Talk about the market, we've got to talk about the tanker market. We've got to talk about what's going on in the macro environment, what's going on in the oil markets, of course. And so I'll be sharing these topics with my colleagues, Kevin Hazel and Aditya Trivedi, as we go forward. Now, the reason why we look at the prospects for the tanker market is not that we all like forecasting. It's because there are important decisions being made right now. And in particular, whether or not you want to lock in a rate set on a long-term basis or continue to play the spot market. Spot market over the past 6 months in the VL market has ranged from about $15,000 a day to $250,000 a day. And recently, the option value of staying in the spot market, has been very high. But things are changing, and you're going to hear more about that as we go forward. But in order to establish the kind of expectations right up front, we'd like you to take a look at this question and tell us what you think is the right thing to do. You're a VLCC spot owner, tanker owner, you're trading currently in the spot market. You've enjoyed rates yesterday about $170,000 a day. Now, admittedly, that's about $80,000 a day lower than they were a week and a half ago, but those are pretty good rates. Now, alternatively, you could charter your ship out on a one-year basis at about $80,000 a day. Which would you prefer to do? Stay in the spot market, have a little fun, or lock in some earnings and sleep well? Please respond to the poll.
All right, Ali, we're at 49% voted right now. Do you want to see the results now, or do you want to give it a couple of seconds? How do you want to play this?
Well, why don't we give it a couple of seconds? 49%. I've never known such a lack of opinion in a shipping crowd. I expect 100% participation. Come on, all push those buttons.
All right, we're rising to 65%. People are starting to motivate.
All right, I like that. All right, well, John, why don't you cut it off whenever you think it's appropriate? I know we have a lot to cover today.
All right, I'm going to close it at 70%, which we just hit. So I'm closing the poll. And would you like the results up on screen?
Yeah, absolutely.
Those are the results. So the results would stay in the spot market at 34% and lock in some earnings and sleep well at 66%.
Okay, well, we have a sleep well crowd here today. That's not going to be the case with this presentation. It's going to keep you awake, but good to know we have a slightly conservative crowd. By the end of the presentation, we'll have a better sense maybe of which answer is most aligned with Marsoft's expectations anyway. So what I'm going to do is talk a little bit about the macro environment. That's, of course, the broad brush that hangs behind all the more detailed oil market and tanker market analysis. But it's a pretty tough job, as you can imagine, to try to capture what's going on right now. I tried to illustrate the pace with which the world is changing from an economist's perspective by just showing here two quotes from Morgan Stanley, one up last month, March 17th, and the other just a few days ago. Just a few days ago, they were pretty pessimistic. Sorry, just 2 weeks ago, they were pretty pessimistic, it seemed. The global growth was going to be negative in the first quarter, negative in the second quarter, but they expected a little bit of growth in the third and fourth quarter. The US economy was going to stand out just 3 weeks ago, positive growth in every quarter, slow growth for the year, but still positive in the midst of a turbulent environment. But look how things have changed. Look how things have changed over the past few weeks. Their current outlook for the second quarter is a decline in GDP from 30 to 38%. And I tell you, there's a very broad range of forecasts that we're seeing, but they all have this extraordinarily steep decline. And because of that extraordinarily steep decline, almost everyone is looking for 2020 to be a recession year. And in fact, some are saying it's the worst that we've seen in the post-war environment. But I think that the annual picture, looking over the 12 months, really clouds the outlook. It doesn't give us enough resolution. And to illustrate that, I just want to show where Morgan Stanley is for the third quarter. Look at this number, 21% growth in the third quarter. If we hadn't had such a terrible second quarter, that would be a truly extraordinary rate of growth. But in this context, it's a slow clawback to even where we were at the beginning of the year. But it's that abrupt change from shrinking economy in the first half to potentially, we hope, growing economy in the second half that I'm going to spend a little bit more time on now. The key thing about the recession that we're suffering right now, and of course the huge public health crisis, is that it's not like anything we've seen before. It's not 2008. It's a COVID public health policy decision to shut down the economy in order to make sure we get through the health crisis as quickly as possible. That's a bet, that's a tough bet that's been made by policymakers around the world. I think there are 1.8 billion people now under, in effect, a lockdown, most of them in India, of course, but we feel it so hard here. And it's had huge consequences as businesses have been closed, and the pain that I think many of us are going through as small business owners is tremendous. But the goal is to manage COVID-19 infections, and it seems to be working. We think we're going to see a peak here in the OECD this month, and we also believe that the robust fiscal and monetary policy that has already been implemented and looks set to be repeated is going to be successful in mitigating the macro side effects of this public health policy. So we look to see that rebound in both employment and GDP growth in the second half. Now, we always talk about a low case and a high case. We're going to talk really more about those within the oil market going forward. But we do keep in mind that there is a less likely low case outcome where we don't see this pandemic declining or the after effects mitigated quickly. 2 weeks ago, that probably had almost a 40–50% chance as a low case as we looked at things then. Since that time, the likelihood of the base case has improved significantly. Now, we're looking at two key things to happen in April and May to give us a strong signal that we're on a base case mode. First, we want to see the reduced COVID-19 incidence and, of course, mortality. And we're seeing that, we now think, in very preliminary numbers, but we're not yet past the peak, and that's what we need to see the second aspect of this easing, which is that the stay-at-home policies, the quarantine, the lockdown, whatever you call it, begin to be eased in June. We think those are two critical events that we need to see in order to confirm we're on that base case path. So far, we think we are, but we think that there's certainly some risk, and we're keeping a close eye on how quickly the economy is going to rebound. With that as background now, I'm going to turn it over to Kevin Hazel to talk about the oil market and what's going on in that very turbulent market. Kevin, the floor is yours.
Okay, Arlie just highlighted the heavy toll that COVID-19 will take on the global economy. And not surprisingly, we think it will also take a heavy toll on global oil demand, primarily on the transportation side as activity dries up. We estimate that total oil demand will fall by more than 13 million barrels a day due to the virus. That's about a 13% drop. To make matters worse for the oil market, OPEC has recently decided to increase production by about 2 million barrels a day is our estimate. Now, normally, we would think OPEC would be cutting production to try to keep the market, the oil market in balance. But of course, we've had the Saudis and Russia unable to reach an agreement a few weeks ago. And instead, we've seen a price war develop where they've decided to flood the market with oil, primarily the Saudis. So this started at the end of March. And we think production is remaining high as we move into April. So as a result of these developments, we're seeing about a 15 million barrel a day surplus in oil prices, in oil supplies develop. That's driven oil prices down. That's been behind the collapse in oil prices. That's saw them falling towards $20 per barrel just a week or two ago. They've since rebounded a bit under some rumors that there might be an OPEC meeting and cutback. They've come back towards $30 per barrel, but we're still down, more than 50% from where we were, just a few months ago before the crisis hit. So, in addition to oil prices falling, we've had bunker prices falling. So, I want to specifically mention what's happened to the differential between low sulfur fuel and high sulfur fuel, which was, a big issue that we were talking about at the beginning of the year with the implementation of the new IMO 2020 regulations. So that differential has significant implications for scrubber investments. Ships, if there was going to be a differential of in the $200, $300 per ton range, we were expecting paybacks for a VLCC of maybe a year or less to pay back for that scrubber. Now that the differential has fallen to less than $100 per ton, we're looking at considerably longer payback periods on the order of perhaps 3 years or longer even for the biggest ships. So significant implications from the drop in oil prices, all stemming from this excess production that's currently in the market. Next slide, please. So if we look at what we think is going to happen going forward in the oil market, starting with Q2, again, we're seeing this $13 million drop in demand. That's not likely to change, I think, for Q2. That's pretty much a given. Could be larger, but it's not likely to be less than that. So how will OPEC respond? Our first scenario is a price war. And both of these scenarios involve, I should say, the base case economic outlook that Arlie talked about. The price war scenario seems to be what we're in at the moment, with the Saudis increasing production. This huge stock build, as I said, 15 million barrels a day, that pretty much fills the excess capacity of on-land storage within a 2 or 3 month period based on the available capacity. And it's also going to lead to a sharp increase in floating storage, as we've already started to see, and my colleague will talk about it a little bit more in a moment. Partly that's due to a contango in oil prices, and it's partly that there's no place else to put the oil going forward. So under this scenario, we would expect to see the prices remain near $20 per barrel, perhaps go less. U.S. shale activity drops very sharply, which we'll come to in a moment and discuss that. And the net effect is that tanker rates are going to soar, as they already have in Q2. Under this scenario, they would stay very high in Q2, probably stay high into the second half as well, because the floating storage is going to last for a bit, even if OPEC does decide to make a cutback. So, but under scenario 2, there would be a sharp OPEC cutback sooner rather than later. And when we talk about a sharp cutback, we're talking 5 to 10 million barrels a day. That leads to a much smaller stock build in the marketplace, less floating storage, and probably props the oil prices up somewhere above $30 per barrel, maybe $35 per barrel to start, perhaps could go higher, by the end of the year. Therefore, having a much smaller impact on U.S. shale, because the break even for U.S. shale for existing wells is probably in the low $30 per barrel range. For new wells, it's much higher than that. So this is a different scenario. Tanker rates would fall back much more significantly, especially in the second half of the year. Not so much in the second quarter, because the floating storage, a lot of this is probably already locked in. But by the second half of the year, when there's less oil being put on the market, there's less is going to be going on ships. That's going to be bad for the tanker market. There's going to be a retreat in the rates. So really, in all of these scenarios, that's really a 2020 scenario I'm talking about. As we go forward into 2021, late 20 and into 21, we do think demand recovers. I mean, again, we're looking at the base case scenario that Arlie talked about, where the economy recovers, oil demand recovers. The problem is how much of an inventory overhang is built up before we see the demand recovering. So it's likely to be significant unless OPEC makes a very sharp cutback very quickly. Next slide, please. So I'll just end on a little bit of the battle between market share that we're seeing between OPEC and the U.S. shale. And this chart shows the OPEC production in the blue line, total North American production in red. U.S. shale makes up about 8 million barrels a day of this red line at the moment. But what's interesting is this has implications for tanker rates. If you looked at the period from, say, 2012 to 2000 through the end of 14, that was the period when the U.S. production was rising sharply, and that led to OPEC keeping production relatively flat, you can see. That was also a relatively weak period for tanker rates. As U.S. oil replaced OPEC oil, it reduced U.S. imports and was bad for tanker demand. Now, when U.S. shale production flattened out from 15 to 16, OPEC gained back a little market share. The price fell, if you remember back then. And that was a good period for the tanker market. So I think a very simple view is that OPEC gaining market share versus the U.S. is probably good for the tanker market, because this is worth discussing in a little more detail. It's hard to discuss quickly, but the U.S. production, only half of it or so is going into exports. The rest is staying in the U.S. and reducing the need for imports. Going forward, I've drawn a couple of dashed dotted lines here. The dashed line is really the price war scenario, where OPEC maintains a high level of production, near 30 million barrels a day. Oil prices drop significantly, remain low, and therefore the U.S. shale production, shown by the dashed line, would probably fall back significantly over the next year and a half. I think the Department of Energy came out with a forecast just earlier this week with about 1.5 million, 2 million barrel a day decline over the next year or so in a low price environment. On the other hand, if OPEC cuts very promptly, as we're showing in the dots here, the price probably stabilizes, the U.S. shale production stabilizes. So that's a very different environment that you're in, depending on how much OPEC cuts and how quickly they cut going forward. On that note, I'm going to turn it over to my colleague Aditya for a little recap of what this means for the tanker market.
Thanks, Kevin. So building on the base case economic outlook that Ali discussed, the key risk factors for tanker shipping market, particularly in 2020, are related to OPEC Plus's decision, which hopefully we'll get to know tomorrow. So first, looking at the supply side for both the tanker segments, it's very positive. I mean, the total order book for tankers is at 25-year lows, and order book to fleet ratio for both the segments is under 10%. So we definitely see a slow fleet growth over at least the next couple of years. With such a positive supply backdrop, the big downside risk for tankers is if OPEC decides to cut the production tomorrow, because such a decision will result in low demand for floating storage and also low demand for trade, as refiners will use the feedstock from inventories. So it's going to be sort of a double blow for tanker rates if OPEC decides to cut production. On the other hand, if OPEC Plus decides not to cut production tomorrow and go full throttle, the onshore storages, we expect them to be full within no more than 2.5 months. And this will result in a high demand for floating storage, and the rates will surge as they did in March. So could we go to the next slide, please? So speaking of March, uh, after OPEC Plus's fallout in the first week of March, we saw that the spot prices and prices to purchase oil in the near term, they tanked. And this resulted in formation of a contango situation. Just briefly speaking, contango is a situation when the prices to purchase commodity in a near future collapse compared with the prices to purchase it in the distant future. So in case of storing oil at sea, the contango or arbitrage is profitable if a trader is able to sell this oil at a higher price than the cost for purchasing the oil and the cost for storing oil. So storing oil is basically the cost of daily rate to hire the ship. So again, after OPEC Plus's fallout, the contango became increasingly profitable in March as further downward revisions were made to demand because of the extension of coronavirus lockdowns. So this increased the floating storage to levels that we've never ever seen before. Actually, if you can look at the chart on your left, uh, now this chart shows floating storage estimates for the decade, but if I extended this chart further in the history using our data, which goes back to the 1980s, we've hardly ever seen such scale of floating storage. So every day in March, as I said, the contango became increasingly profitable, and this rally actually stopped when Trump tweeted that Russia and Saudis would negotiate to cut production. Now, there were other indications as well, but which confirmed this news. So looking at the chart on the right now, before Trump's tweet, the 6-month contango on the 31st of March, which is shown by the blue line, this was close to $11 per barrel. And a trader would have made profit if he hired a VLCC for 6 months at anything less than $120,000 per day. So that is shown by the blue bar. After Trump's tweet, the 6-month contango shrunk, and this was about $7 per barrel, shown by the orange line. And the break-even time charter rates also reduced dramatically. So instead of $120,000 per day, now you'd make a profit only if you could get a VLCC for less than $70,000 per day. So this is shown by the orange bar. So this mainly shows how quickly floating storage can become less profitable and even unprofitable. So if OPEC decides to cut production tomorrow, we can expect the contango to shrink towards the orange line, or in fact even below it. And we can expect the floating storage to become less profitable. And on the other way around, if OPEC decides not to cut production tomorrow, we can expect the contango to be profitable, and we can expect higher number of floating storage. So going to the last slide. This chart shows how VLCC rates would react in our base case if OPEC was to change its production, given all other circumstances the same. So currently OPEC's March production is estimated to be over 29 million barrels per day, slightly over. So this should result in VLCC rates of about $60,000 per day. If tomorrow there is no agreement for the cuts, OPEC's production and if OPEC's production increases by 2 million barrels per day, and let's say if it averages to 31 million barrels per day in the second quarter, we are looking at VLCC rates close to $120,000 per day. On the flip side, if Saudi and Russia decide not to adopt cuts, and if they decide to restrain production by 5 million barrels per day, which is on the conservative side, we are going to see VLCC rates of about $20,000 per day. So I mean that's a lot. There's a lot riding on tomorrow's OPEC Plus's decision. And considering this, I'd like to end this presentation with a quick poll for the audience. Next slide. Yeah. So will an OPEC agreement to cut more than 5 million barrels per day be announced over the coming month? If you think that OPEC would agree to cut 5 million barrels per day or more, please vote yes. If you think that there won't be cuts, or if you think that there'll be lesser cuts than 5 million barrels per day, please vote no. So I think I'll hand it over to John and Ali now.
That's fantastic. Thank you, Aditya. So while people fill out this poll, I mean, Ali, what do you personally think about the OPEC? Will OPEC cut?
I think that the OPEC game is still playing out. My sense is that there will be a cut announced, and then there will be cheating thereafter. And so we're unlikely to see a 0-1 decision. We're likely to see a significant cut announced in the short term. That will probably have a sharp effect on oil prices. But I think the Saudis are going to be watching very closely how U.S. shale oil producers react to that. And you can turn the taps on a shale oil well very quickly. And so if they see that the decline in shale oil production that we've seen so far this year is arrested or even turns around, I suspect that you're going to see the Saudis open their taps one more time.
Okay. Now, audience, feel free to send in some questions. We have a couple right now, but would love some more. The first question for the team will be, will the US start exporting oil at the lower oil prices?
Kevin, why don't you take that one?
Sure. I think they will, but there'll be reductions as the production is reduced, which again, we're seeing forecasts that that's going to come off a couple of million barrels per day. The exports are likely to come off as well. What we saw when the production was increasing was about 50% of the increase in production was exported. And I would assume it would be similar on the decline, that as if production falls 2 million barrels a day, I would think exports would fall close to 1 million barrels per day.
Kevin, let me just jump in with a follow-up on that. Don't we also have a phase 1 trade agreement with China that is playing in here?
We do. So on what China had promised to buy more U.S. oil as well as some other products. So that will probably stay in place. But the U.S. was also exporting significant volumes to Europe and other Asian countries, Korea and India in particular. So I think the Chinese, if they live up to their part of the bargain, will ramp up their imports from the U.S. But if the total supplies from the U.S. are diminishing, there's going to be cutbacks in volumes going to Europe and the rest of Asia. And of course, it matters for ton miles where the cutbacks take place. If it's European volumes that are cut back, that's not so bad for the tanker market. If it's volumes to the rest of Asia, and OPEC gains some market share there, that could, that would be more negative for the VLCCs.
Great. We have another question. Why has the Brent WTI spread increased to $8?
And that's very recent. I mean, I don't really know why that's happened, other than the fact that I think, U.S. The spread had narrowed, I think, to a couple of dollars per barrel last week, and now it's widened again. I'm not really sure that is, if it's U.S. production being shut in at such a low price, more than the world market. So I don't really have a good answer for that.
Okay. Then follow up, another question was, what impact would Trump oil tariffs have on tanker demand?
When we impose tariffs on Saudi oil?
Yeah, that is one of the proposals, and that serves to protect the U.S. That produces a little bit of an artificially higher price for U.S. oil that might stem the decline in U.S. production to some extent. I'm not sure the Saudis are going to appreciate that as Trump trying to get, but I think that was more of a threat, that if they don't cut production to raise the price, he might consider doing that as an alternative way of raising the U.S. price, at least artificially, domestically. But so maybe the Saudis and Russians will get the hint. But yeah, that would be an interest. I wouldn't, when Trump starts talking tariffs, I would probably listen. You know, I wouldn't. I would take him seriously.
Well, I think the textbook answer to that might be, John, that an increase in price in the U.S. would probably reduce consumption, and tariffs, because they're a tax generally paid by consumers, would reduce economic activity. So it's likely to will see negative consequences for U.S. consumption. The textbook's been kind of thrown out in the current emergency, so not sure how things will respond. But I would think that that would be, at least at first cut, negative for consumption in the United States.
Okay, great. Now we're at our time right now, but we have a couple more questions that I want to throw out to you to make sure the audience has heard. And then, so anybody that's willing to drop off, feel free to do so now. But another question is, what is the chance of US, Norway, and Brazil joining a global supply cut with OPEC?
Which countries, John?
US, Norway, and Brazil.
Joining a supply cut with OPEC as part of a real OPEC plus agreement. Is that the question, sort of?
I believe so, yes. OPEC plus.
Yeah, but we can be simple. The chances of that are zero. I mean, there's no chance it's going to happen. It's an interesting headline conversation, but you're not going to see the U.S. join in coordinated production cuts.
I don't know if I agree at zero, but I would think it's it's probably low. It's hard to. I think getting the U.S. to curl production. There's been some proposals in Texas to do a 20% cut, but I think it's a little bit like herding cats, trying to get all those small shell producers to agree to that.
Well,
right.
I can tell you that every lawyer on this call is watching that carefully, and as soon as someone in the U.S. announces a coordinated production cut, they're going to get hit with every kind of lawsuit you can imagine. So I'll stand by my zero. John, I see we're coming close to the end of the program. What's the vote on the 5 million barrel a day cut?
I'm sharing those results with people now. So 59% said yes and 41% said no.
Wow. And 70% chartered their tanker out, huh? Huh. Okay. Well,
Yeah.
I'm not sure that shows a great internal consistency in the Marine Money audience, but it's.
No, I think it does. If you believe there's going to be a cut, you should be locking in the rate. I mean, it's not 1-to-1, but there's 5% inconsistency.
That's true. 5% inconsistency, I guess, is in the noise. Well, that's a good point. Hey, John, thanks very much for hosting and to Marine Money for putting together these great events. We really appreciate it.
Absolutely. Thank you, Ali, Kevin, and Aditya for taking us through this exciting, if not volatile, subject. This webinar will be posted on our site later today or tomorrow, so keep an eye out for that. And we will keep you updated on the next week's webinar. But for now, this is John Chair from Marine Money signing out and wishing you good health and wealth during these times. Thank you all.
Thank you, John.
Thank you.